Great to see you again. I'm glad
Thanks,
to have
ma'am.
you here.
Thanks for having me, and happy to be back for the second time.
Fantastic. Happy Friday to you and to everyone joining us. And we'll invite everyone joining us here today to send questions in. So go ahead and do that. And Raghav will take a stab at them throughout the next half hour. Let's begin with these three ideas. We're going to go through bonds, then we'll discuss the factors and which ones are the best, basically, sort of from the equity side of things. And then we'll go into the all-in-one ETFs and discuss how those allow you a particular type of access to all these different ideas.
Sounds good.
But first of all, with bonds, it's been a fascinating time to watch actually the rate cycle and what it's meant for bonds. As we say, we're in a lower interest rate environment. Yields are higher, actually, still.
Yep.
We've been talking about this a lot. What the heck's going on there from your perspective? You're actually a bond guy, right? That's
Exactly.
your world.
Yep. So my background's fixed income, and I've been a bond guy ever since I started my career. So there's a lot to digest in terms of what's happening with the bond markets. Yields are still higher, and thanks to the Trump trade, Trump getting re-elected and the US elections, the yields have climbed up. But actually, it's given investors another chance to actually get in and lock in the higher yields that we're seeing in the market. If we take a step back, I want to spend a few minutes talking about how can we help position ourselves amidst this rate cutting cycle that's still underway. Yeah, so we take a step back, despite the fact that we are kind of in a scenario where we've seen volatility and Trump trades pushing the yields back up higher, we've lost our sight of the fact that we are still seeing rate cuts. So if we talk about the flows, last year, for example, same time, this time of the year, but last year, 2023, September, October, over 50% of the fund flows in the ETF world were attributed to money market ETFs, right? But the same
Short duration.
same number this year is less than 10%. So that tells me that there's still a lot of interest by the smart money from the investors and advisors to start looking at adding duration and extending duration. Because the reality is, 4 rate cuts later in Canada and 2 rate cuts later in the US, stuff like money markets, GICs, your cash-like products, they kind of lose their appeal for the investor base because of the rate cuts and the lower yields on the front end of the yield curve. And at the same time, the same investors want to shift up higher along the yield curve in search for that higher yield. So that goes to say, naturally, that makes them forced towards extending duration and adding duration over time, slowly but surely and gradually. So if you look at south of the border, we've seen a record-breaking number, 84 billion in fixed income flows into duration products. These are your actively managed bond ETFs. And there's a clear reason why that's happening. So if you actually take a step back, there's a lot of uncertainty in the bond markets nowadays. If you look at bonds, why? There's 3 reasons. Number 1 is the volatility because of the rate cuts and the central bank decisions. Number 2, geopolitical risks, what's happening in Ukraine, Middle East, and all the war that's going on in Europe and Middle East. Number 3 is basically your rallying and the volatility that we saw around the US election. So more and more investors are looking to using bond funds to, I guess, not only manage the risk through active ETFs, but also lock in duration and credit opportunities to extend the return and the yields across the fixed income side of the portfolios.
Is there a fly in the ointment because we are seeing rates rise?
Yes, rates are rising. That's because of the Trump trade. So again, if you go back in time, I think everybody in the marketplace got slightly distracted from the rate cuts.
Okay.
And we kind of went backwards in terms of the progress that we've made so far with rate cuts. The yields have risen because all the risk-on asset classes actually rally when Trump gets reelected. That's what we've learned in the past. But then again, it's giving investors time for the net new money to come in and lock in the higher yields and find another new entry point for the bond markets. And again, I think we should not overreact in the short term. So yes, Trump administration would bring a lot of excitement with the changes that are yet to come, but nothing's implemented yet. So I think it's a wait and watch approach. It's a wait and see approach. We still have more work to do when it comes to taming inflation. But that being said, the numbers and the data is telling us that there's still more rate cuts to go, both in the US and Canada, and that's when longer term bonds outperform. So if I bring up the first slide.
Let's bring up one of the slides here.
Yep. So the first slide, if we look at how stocks and bonds have behaved, we went back in time and we studied how stocks and bonds performed in the 3 years on average after the last rate hike. And if you can see here in this chart, in this slide, bonds have actually delivered a lot more superior risk-adjusted returns on a relative basis versus stocks. So if you look at the number here, bonds have actually a much higher Sharpe ratio, which is roughly your return divided by risk being greater than 1, whereas on the other hand, over the last, I guess, 40 years since the 1980s, if you look at those 3 years after the last rate hike, stocks have delivered a much lower Sharpe ratio, close to 50% or 0.5. So that tells us that it's the longer duration bonds, the long-term bonds that actually outperform in a declining rate environment that we are in, given the rate cutting cycle that's already underway. So again, if you want to take advantage, we have some ETFs that we can talk about if that answers the question.
No, yeah, it does. I have more questions there, just a little bit anyway. In terms of the risk, I mean, this has been one of the, it's like a new type of Fed put in a way, because the Fed has so many different options to deal with the economy if it really slows, and that it has not had to deploy in a very rapid way. For instance, it's got sort of a slow start here. That said, it just seems like, how do you compete with yields that have been so high in such a safe investment? I mean, this is sort of the risk-adjusted argument that you want to sit in bonds, you've got high yields, and I think, as Jeff Moore says, you're clipping coupons, right? It's a good place to be. That said, there's a lot of excitement over equities.
Yes, so there is a lot of excitement over equities, but I think there is still a place for bonds in every advisor's portfolio. We kind of lose sight of the fact that bonds are designed to capture the yield, and we shouldn't, I guess, focus too much too soon on just the duration trade. It's also the higher yields, the carry. That's what the bond guys called carry. So the higher yields, what they do is they let you clip coupons on a monthly basis with these bond funds, but at the same time, you are minimizing the volatility of your overall portfolio by using bonds, if that answers the question.
Yeah.
And should we turn over to equities, or should we cover the...
I want to just take a look at sort of the core strategy versus the global investment grade. These are the ETFs that could work for what you're describing right now.
Exactly.
What would be one versus the other?
Sure. So if I want to bring up the next slide, which is basically the Global Core Plus and the Global Investment Grade, we have these two products. They belong to the multi-sector fund family. Now, these are both actively managed. Risk rating is low. They deliver monthly income. They're very similar products managed by the same team of portfolio managers. The differences are the Global Core Plus is the more aggressive of the two, with a greater allocation invested in high yield bonds.
Okay.
On the other hand, Global Investment Grade, as the name suggests, investment grade invests a relatively higher allocation to investment grade bonds as opposed to high yield bonds. Now, they're both tactical, they're both flexible, nimble strategies. To put things in perspective, back in 2022, when the rate hiking cycle was underway and rate hiking cycle began, Jeff and Mike were quick to dial down the duration to bring it down to as low as 3.9 or 3.6. And 24 months or 18 months later, we are now sitting at duration at about 6.6 or 6.4, depending upon which one of the two strategies you're looking at. So it's meant to be a flexible, nimble fund, which can use a lot of tools at the PM's disposal to add value, whether it's security selection, sector rotation, asset allocation, currency management, duration and curve positioning or yield curve positioning. These are some of the many tools at their disposal that they can use to play offense or defense, again, in a global mandate, packed or packaged in an ETF offering, 56 beeps overall, which is half the price of your average bond fund.
It's sort of amazing how tactical it can be, actually, just listening to what you were saying there. Is there just any other note on flows to sort of, I mean, ETFs have become incredibly popular just as a statement, whether they're bond ETFs or not.
Exactly.
Is there anything just to layer on top of the comments you talked about bond flows recently, because of rate cuts, obviously, but just sort of the popularity of ETFs as well?
So normally in the world of ETFs, equities is this cool kid on the block, but the tide has actually shifted. If you see over the years what's happening, given how bonds have made a bit of a comeback amidst higher yields and rate hikes. So if you look at the net assets in the world of ETFs, fixed income ETFs now make up about over 20% of the total ETF assets globally. We've never seen such a higher number.
Wow.
In fact, if you count the total AUM for bond ETFs combined across the globe, we are now slowly inching towards $2.5 trillion in assets under management. So the tide has shifted. And speaking of flows, to answer the other part of the question, south of the border, year to date, we've seen 84 billion net inflows into fixed income and actively managed bond ETFs. So that's 84 billion year to date in this year alone as of October 30th or October 31st. This number, 84 billion, is actually much higher than all the total inflows of 2021, 2022, 2023, 3 years combined. So it's a record-breaking number, which tells us that it's a screaming signal that bonds have made a comeback, and now is a time where smart money, smart investors are now slowly inching towards adding duration. So regardless of the fact that we've lost sight in the short term because of the Trump elections and bond yields moving higher, it's giving a chance to investors to lock in higher yield and capture that yield while positioning yourself in a lower interest rate environment where the GICs, the cash-like products, are not giving you that same level of yield and safety net that they were back in 2022. They've done a good job, the GICs and HISAs and the money market ETFs, over the last couple of years, but I think the tide has now shifted given where we are, and accordingly investors and advisors have to reposition their portfolios for this new regime where we've already seen 4 cuts in Canada, and 2 cuts in the US, and there's more to come.
Yeah. Okay. Fascinating time also because ETFs are doing so well. Let's move on to factors. This used to be called quants a long time ago. There are nuances there, but you're not just a bond guy, you're also a quant guy, which is sort of amazing that you've done all this schooling towards it. Momentum trading is a really interesting part of the world. We see lots of it going on right now. That Trump trade was incarnate what momentum is. What are the 2 best factors? Because it goes well beyond that. There's low vol, there's lots of other different types of factors. But bring us to the world of factor trading and what works best right now. Again, lower interest rates.
Awesome. So I guess I want to take a step back and explain. I know we've covered this many, many times whenever myself and my other co-workers or this other strategists, they appear on Connects. We've done the basics of covering and explaining what a factor is, and we've done it well. But I want to tell you that the factors, the way they're designed is we've hired all these super smart guys, PhD, computer science degrees. Yes. We call them quants. We also call them financial engineers. They've worked on processing tons and tons of data to design algorithms and quantitative models. And these models, these algorithms, have kind of automated the stock selection process to the point we are using machines to pick and analyze chunks and chunks of data to pick the best, most compelling stocks, and that's what a factor does. So factor-based portfolios have some clear advantages. So on the downside, let's say if you look at some scenarios of a large drawdown like the financial crisis, the 08-09 subprime credit crisis, the dot-com bubble burst back in the early days. On the downside, factors protect your client portfolios by only capturing 80% of the drawdown versus the full market because of the tilt towards high quality and low volatility stocks. So this is the downside, right? So for example, if you look at the market, the S&P 500 on average dropping about 30-35% in an average drawdown or a stress scenario, the factors like low volatility will drop a lot lower and will tend to outperform by dropping only, say, about 20% on average. That's because of the filter and the screen for high quality and low volatility stocks. Similarly, advantage number 2, on the upside, if you actually go back in time since the time the word factor was invented, or since the time, the early years when we invented the very first factor since 1980s, you look at high quality, low volatility, value, momentum, and all the other factors combined, and you compare the performance of each and every factor versus the broad market, the S&P 500, history tells us that factors are proven and designed to outperform the broad market over time. So these are the 2 advantages. And then going back to the second part of the question.
Yeah, so the question, we're just going to take a look at rate cuts particularly, and which couple of factors, or I mean, I guess not all of them work well in this moment particularly. What are the best two?
Yep, and to answer that question, I want to bring up slide number 4, I think. Slide number 4. So two best performing factors in the last 5 rate cutting cycles on average, if you study the 1980s, the 1990s, and the early 2000s, have been quality and momentum. And this is based on median relative return or median relative performance, as I've shown here on this chart. So that's momentum and quality, the two factors, and I want to talk about each of the two for a couple of minutes, if that's okay.
Yeah, no, well, let's do that. I mean, so let's go to quality first. I mean, so what is quality, if you want to describe? These are big companies run well.
Exactly. So as the name suggests, quality, quote unquote, you are buying the quality factor, which ensures that you're buying into the highest quality businesses, the most resilient companies that can stand the test of time. And the way we do that, our algos and our quant models have designed processes to pick the best stocks with the highest return on invested capital, highest profitability, highest earnings growth versus their peers in the respective sectors, highest free cash flow yields, and things like quality balance sheets, low levels of debt, and again, sales growth and performance growth over time. So companies that are mature, less cyclical, that will stand the test of time. And again, this ensures that you're buying quality businesses that will prove to outperform over the long term. But then again, if you look at what's happening in the market right now, S&P 500 is trading at all-time highs. So that really is a no-brainer. It tells us that this is the time to kind of buy high-quality businesses, resilient businesses that can stand the test of time if in any scenario we might see a correction or a small volatility shift in the equity markets.
We can lose this slide. The next slide actually goes to quality and momentum, so maybe we'll just pull up that next one.
Right, exactly.
Because that goes through some of the things you were just discussing there. There's the high quality factor, ETFs themselves. Yeah.
And the second thing that I want to talk about is, we are in the late cycle right now where the economic growth has been reaching its peak and it's kind of stalling. So this is the time history tells us when quality stocks tend to outperform, and you want to be overweight quality names, and that's what these ETFs help you achieve with our factor portfolio. So we have them available as 4 different ETFs, FCCQ for Canada, the Canadian quality stocks, FCUQ, and that's for the US, and then we have the hedged version, FCQH, and then we have, last but not the least, the international quality. So these stocks these ETFs seek stocks with a higher quality profile. Again, the things that I've mentioned, the rules that I've mentioned, attributes like higher return on invested capital, higher free cash flow yield, higher profitability, higher earning growth versus their peers in the same sector. These are the quality names. And then we can, I guess, move over to momentum.
Yeah, I might just ask you, though, that also has a call on where we are in the cycle, and that tends to be late cycle. So,
exactly.
So now I have to ask you about the cycle. Where are we in the cycle?
So we are somewhere in the middle of the late cycle. Bobby Barnes, our head of the Factor Quants team, he likes to call it the extended late cycle or the late cycle, where a recession hasn't happened. We've all been talking about it. We've all been saying, when will it happen? But we are now in the US turning towards a softer landing or a no landing narrative. So we are still stuck in the extended or the late cycle where a recession never came in the US. In Canada, it's a different story. But yet again, the growth is not as high as to the point that it brings us back to the mid-cycle. So we're kind of stuck in this awkward middle ground where economy is still resilient, yet we're not seeing any risks of recession. But at the same time, it's still not as high as something that would bring us back into the mid or the early cycle. So that's when you want to be positioned for high quality and momentum stocks that can perform the best in a declining rate environment, and you can accordingly position your portfolios with these factor ETFs.
Okay, fantastic. Okay, so let's take a look at momentum at this stage. We'll bring that slide up if you don't mind.
Yes.
And these are the momentum, just as it suggests. You want to get out of the way of the train, right? Let the momentum run, let it roll. Yep. It might be the one after the quality.
Next, please.
Yeah, so there's probably 2 after that, possibly. There we go.
That's right.
Yeah.
So momentum, as the saying goes, picking and sticking with winners that continue to win and avoiding losers that continue to lose. That's what the saying goes, and that's exactly what momentum does. So one of the the next best performing idea in the equity market, if you look at the factors, is the momentum stock. So the momentum style of investing performs the best in a declining rate environment, and we've already seen that with the rate cuts that have happened. If you look at, for example, FCMO, the ticker, that's the US Momentum ETF, that's up almost 48% year to date. And we've actually outperformed our passive peers, Vanguard, iShares, as well as BMO ETFs in Canada, if you look at their respective momentum ETFs. In fact, I want to, I guess, digress slightly away. So the quality ETF, FCUQ, that I mentioned earlier, and this one, the momentum ETFs, we've won some Lipper awards as well recently. So
yes.
We are overall.
There have been a number of Fidelity Lipper awards awarded to Fidelity.
Thank you. And FCUQ has gotten the award for the best 5-year return overall versus a lot of our peers in the country for the US Quality Factor ETF. So yeah, back to momentum. Momentum, if you look at momentum, it's one of those areas, as I've said, that performs the best when we are seeing rate cuts. But at the same time, if you look at inflation numbers, as inflation, depending upon which measure of inflation you're looking at, as inflation arrives within that 2% band or 2% range, we see an inverse correlation between momentum stocks and inflation. So as inflation numbers drop or cool down over time slightly and gradually on a piecemeal basis, that's when momentum stocks or momentum style of investing outperforms other sectors of the market, other domains or other factor types within the equity markets. At the same time, so the rate cutting cycle and this inflation phenomenon that I've mentioned, along with the fact that we are seeing a soft landing narrative, all of these things will help boost and propel the momentum factor further. That's why we are still bullish as it outperforms in a declining rate environment when we see rate cuts that have already unfolded.
So let's bring, I think you put it this way, sort of the distraction of the election into the momentum story, because that was momentum.
Exactly.
That was wild. Markets maybe just taking a bit of a breather the last couple of days here. But I mean, just sort of put that into context for us. Everything that you would have been positioned for, say, before the election in terms of momentum to do with rate cuts, would have worked through that?
Yep, so momentum also happens to be a fast-moving factor. So if I look at comparing factors, high quality, low volatility, value, and momentum, out of these, momentum is kind of like a proactive and a reactive factor. So if you go back in time and we studied factor investing and factor portfolios, history has taught us that momentum actually starts swinging up or outperforming even before the rate cutting cycle begins.
So it's amazing. So now we're going to put it all together because we've talked about bonds, we've talked about equities, and we come back to the 60-40 is very much alive.
Exactly.
And so it leads us to the Fidelity all-in-one solutions, and there are different versions of this. But essentially, if you want to use some of the factors, use some of the funds that are available for that, or if you just want Fidelity to look after all of that in a one solution. It's a very easy name to get behind. Let's bring up the first slide on these because it allows you to see how.
That'll be the last slide.
It'll be okay. So it's the last one. We may lose it and bring it back a couple times, but just talk us through. Like there it is, putting them together.
Yep. So that's a great, I guess, way to pivot into the all-in-ones. Now, a lot of simpler investors and advisors who want to keep things simple, they might not be as sophisticated as the other professional investors, or not, I guess, less savvier is a better word. They might find it cumbersome to constantly having to readjust, rebalance, and tilt their portfolio one way or the other, depending upon which factor is meant to be outperforming in a particular market cycle. So for those, the reality is it's hard to time the individual factors across different market cycles. And what combining factors does is it actually helps lower your overall portfolio volatility over time and also improves the long-term performance of your portfolio over the long run. And again, combining factors and holding them in a mix can actually improve the performance over different business cycles of your overall portfolio. So here we are with the all-in-ones. We came with this lineup. We took all the 4 factors, quality, low volatility, momentum, and value. And
there are the bond funds, one of them you're talking about.
Exactly. We packaged them all together. Now you throw in the bond ETFs that I've talked about into the mix.
Yep.
And now you get a fully managed, fully rebalanced, all-in-one, one-ticket solution. One single trade, one single line item. You buy into the ETF, gets you access to the highest quality stocks and bonds, over 500 high-quality stocks and bonds, handpicked, carefully selected, and curated based on proprietary research. We've really put in a ton of work back testing and quantitative research to actually design and come up with this asset allocation. So they're all scientifically designed portfolios. If you look at the screen, they come in 4 versions, from the most conservative to the far left to the most aggressive on the far right. So this is really your...
Most aggressive meaning it's all equity.
Exactly.
Like there is no balance of bonds in that particular one for investors who want that.
Exactly. So the more conservative you get, the more bonds you would own through these ETFs in the mix, and lower the allocation towards equities. And the more aggressive you get, on the other hand, on the flip side, the lower the allocation to fixed income and bonds, and the more equities you would own.
So we'll lose the slide for a second. I just want to ask you a little bit about the equities themselves. Do they end up being, this is the big question, do they end up being US equities at this point, largely? Because you got the dollar, and there's an argument of TINA. Not everyone agrees with that, but I'm just curious where these land.
So if you look at the most aggressive portfolio of the 4 on the far right on the previous screen, on the previous slide that we can bring up again.
You can pull it up again.
We have a very large overweight to US equities. In fact, if you actually go on fidelity.ca and you look at the mix or the breakdown of these portfolios and what's inside the basket, over 50% of our equities, or we have a 50% overweight in equities towards the US markets, and that's the largest markets, and that's what's done well for us over time, especially on the equity side when it comes to peers beaten and performance across this lineup, this award-winning lineup of ETFs. And speaking of performance, performance is net of fee. So every single month-end, Morningstar, Fund Data, and all these agencies, they rank us versus our peers in our respective categories for each of these 4 ETFs. Since inception, since the time we were launched, we are 100% peers beaten. And if you look at the FBAL, the balanced, and FGROW, the GROW, I'm calling out the tickers as well. We recently won the Lipper Awards for the best mixed asset ETFs overall, and also the best overall ETF provider this year with Lippers.
Congratulations.
So that's a little bit about these ETFs.
There's a little bit of Bitcoin in those. After the election reaction, you ever wish there's a little more?
Yes, that might see the allocation tick up a little, but at the end of the day, we still have a 5% cap to Bitcoin. Okay. Now, speaking about Bitcoin, I was actually reading on my Bloomberg terminal and the news. For the first time after many, many years, Bitcoin as an asset class, the market cap of Bitcoin has now exceeded a precious metal like silver. And that makes it the 9th largest asset class amongst all the other asset classes in the world that you could invest in or one could invest in, which is why Bitcoin is kind of like one of the favorite asset classes to be in. And with all-in-ones, we are the only providers to have included a tiny sleeve of Bitcoin through our Fidelity Advantage Bitcoin ETF in the portfolios. Now, if you talk about Trump, you talk about geopolitics, all the risk-on asset classes end up rallying the hardest, and crypto, Bitcoin being one of the best ones. We are up at, I think, 87,000, and we touched just shy of 92,000. So Bitcoin's up and it's rallying, and you might miss the boat if you're not into it.
Yeah, it was an amazing time, and there you go. It was in all of those all-in-ones. Raghav Mehta, thank you for joining us, taking us through those amazing ideas for the ETFs and great visuals. Thank you for those.
Thank you for having me. Thank you.